This content reflects my personal observations and learning process while studying financial markets and digital assets. Any discussion of trading strategies or market structure relates only to my own trading framework and personal trading system. This material is for informational and documentation purposes only and should not be interpreted as financial advice or a recommendation to buy or sell any security or digital asset. Episode 14, Why Crypto is More Volatile Than Stocks. As I continue learning about digital asset markets, one characteristic becomes immediately clear. Cryptocurrency markets tend to be significantly more volatile than traditional equity markets. Large price movements that might take months in stocks can sometimes occur within much shorter periods in digital assets. Understanding why this happens is important for anyone trying to navigate this environment. One factor is market liquidity. Although the cryptocurrency market has grown significantly over the past decade, it generally remains less deep than the global equity market. Because of that, shifts in supply and demand can move prices more quickly. Another important difference is the structure of trading hours. Unlike stock exchanges, which operate during specific market hours, cryptocurrency markets trade continuously. 24 hours a day, 7 days a week. That means price discovery never pauses. News, sentiment changes, or large transactions can affect price at any time. Market structure also plays a role. Digital asset markets are still evolving, and price movements can be influenced by investor sentiment, adoption trends, macroeconomic conditions, and regulatory developments. In addition, many cryptocurrency markets include leveraged trading through derivatives. When leveraged positions are liquidated, those liquidations can accelerate price movements and create sudden bursts of volatility. For retail traders, these characteristics can make digital asset markets feel unpredictable. But volatility itself is not necessarily negative. Volatility simply reflects how quickly prices are adjusting to new information and market activity. The real challenge is learning how to operate within that environment without allowing rapid price changes to disrupt the structure of a trading system. For me, that means returning to the same principles that guide my approach in other markets. Capital exposure must remain controlled. When markets move quickly, position sizing becomes even more important. Maintaining sufficient reserves helps ensure that the system can absorb volatility without forcing reactive decisions. Entries must remain structured. Instead of reacting to every price movement, positions should only be opened when conditions align with the predefined framework of the system. Patience also becomes essential. In volatile markets, opportunities may appear frequently, but discipline determines which opportunities are actually worth acting on. In many ways, a structured trading system becomes even more valuable in markets that move quickly. The faster the environment, the more important it becomes to operate with clear rules and defined risk management. Digital asset markets may continue evolving, and volatility will likely remain a defining characteristic. But rather than trying to control the market, the goal is to control how we participate in it. And as with every step in this exploration, the principle remains the same. Before capital moves, understanding must come first. And in every market, knowledge should come before allocation.